All right, then, econ friends, welcome back. Welcome back to another lecture series. In this one, we're going to be jumping out of product markets, and we're going to be talking about resource markets. And specifically, we're going to focus on the resource of labor, which for most of you is the most important resource, because as you finish up college eventually and move into the labor market looking for a job, this is going to be the one that really is influential to you. So anyway, what we're going to do in this lecture series is we're going to start off by discussing resource markets broadly, kind of get some context. And then from there, we'll jump specifically into an economic analysis of labor markets. Okay, so again, we're jumping from product markets, which we had been doing up to now, into resource markets. And we're going to focus specifically on one of the different resources, and that's labor, to really drill down in economic analysis of how this works, okay? In this video, let's start off though at kind of a top level, kind of a bird's eye view, and really get some context behind resource markets. Let's jump in. So the big thing to bear in mind is, as I said a moment ago, we've been studying product markets up to now. And again, you know that product markets, these are the ones where you and I, we're consumers. We as consumers purchase goods and services, and these goods and services are made, produced by, and sold by firms. So up until now, we've discussed product markets. Now, however, we're shifting over to factor markets. And in contrast to product markets, in factor markets, okay, these are resource markets. They're also known as factor markets. They're also known as input markets because these are resources for production, also called, as you know, factors of production, also known as productive inputs. All these terms mean the same thing, okay? But the big picture here, again, in contrast to the product markets, in a resource market, a factor market, an input market, it's the firms, the businesses that are hiring productive resources, machines, tools, robots, factories, workers, etc. It's the firms that are hiring these productive resources and using them to produce the goods and services that they sell to us in product markets, okay? In other words, my friends, in this new market that we're going to discuss, resource markets, business firms are the purchasers. They are demanding the resources that they need to produce goods and services. And critically, households, that's you and me. We are the suppliers, the sellers. And we're supplying resources, our labor, our land resources, our capital resources that we own. We supply them, we sell them to firms in exchange for income, okay? So it's really important to understand that in a resource market, the traditional roles of supplier and demander, they're flipped around. Households, we're supplying the resources that we own. Firms, they're demanding them and buying them, or renting them from us. You might recall this diagram from early in the class. This was the circular flow. Up until now, we have been covering products and product markets. And you'll recall that in product markets, businesses up here, they are sending to you and me, to households, products, and in exchange, we give them money. We pay for it, okay? You'll recall from our early discussions that we consume goods and services in order to get utility, right? Happiness or satisfaction. And the firms use that revenue in order to earn their profit. And that was that kind of reciprocal, interdependent nature of that market. Now, however, we're jumping over here. Let me make this a little bit easier to read. We're jumping over here into resource markets, aka factor markets or input markets. In these markets on the circular flow, it's the other part of the circle. You can see here that households, that's you and me, we are supplying factors, land, labor, and capital, and these resources are then going to businesses. They use those resources to make the goods and services. And in exchange, the businesses up here, they have to give us income. We know that that income has different names: wage, or rent, or interest. We know that wage is the income for labor, and rent is the income for a land resource, and interest is the technical name for the income payment for a capital resource. Okay, so we have these terms, wage and rent and interest, but at the end of the day, all they reflect are forms of income that households receive from businesses in resource markets. And this is the side that we're going to be covering in this lecture series. Okay, a couple of context points just to really reinforce the knowledge. Number one, it's different, but product markets are still markets. And it's a little bit confusing because the roles are reversed. There's a few other little things that we'll talk about, but don't forget, we're still talking about a market. So we're still going to be analyzing the forces of supply and demand. Specifically, we'll be analyzing the supply of labor and the demand for labor. And as in any market, we know that supply and demand come together, and this is how we determine prices. You can think of this, since wages are the prices of labor. Okay, wages are that's the money that we make working. Since a wage is technically just a price, the price of labor, we know that the supply of labor and the demand for labor, the labor market, that's how we're going to determine how people earn what they earn, or at least be able to make some really good predictions about who will make more and who will make less. Okay, it's all about the supply demand analysis. So no matter how confusing this seems, always go back to your first principles. Supply and demand come together and give us price, okay? In terms of context, it's also important to know that broadly speaking, we can take all these different types of inputs, okay, these factors, these resources, and break them up broadly into two categories. The first category would be non-human resources. Non-human resources would include things like machines and land, and even natural resources. All these non-human resources ultimately come together to help us create current output, the stuff that we'll consume today, as well as future output, the stuff that we'll consume later, okay? Economists refer, and you've heard this term in the class before, economists typically call these non-human resources physical capital. So you've heard the term physical capital or the capital stock. This refers to the non-human resources, the land and the capital components of the factors, okay? The second broad category, as you can imagine, would be human resources. And this is basically the labor component, which we're going to focus on. But broadly speaking, again, we're trying to get context here. Human resources, it's going to consist of not just workers as a general concept, but of the skills and the abilities and the knowledge and even the health of the human beings that contribute to the production process, okay? Of the humans that contribute to the production of both current and future output. Okay, so we're going to be able to take these resources and categorize them as non-human, aka physical capital, and human, aka labor. Okay, they're going to behave the same in the product markets with supply and demand, but we're going to separate them. Okay, another important part of the context of this is the concept of investment. And we've discussed this term a few times in our economics course. Let's put this term to use in the context of resource markets. You can consider investment at its basic sense to be an allocation of resources. Investment involves decisions, typically by firms, sometimes by government, typically by firms, to allocate particular resources in particular ways so that we can increase future productive capacity, okay? Investments, therefore, are effectively forms of spending that are designed to increase the economy's overall productive capacity, the amount of stuff that we can produce and consume. We know that we can have, number one, a form of investment in physical capital. So we had the categories above of physical capital and human capital. We can make investments into those different categories. Investment in physical capital, that could include things like making more machines, discovering natural resources, maybe upgrading the quality of land. It's allocating resources to make the non-human factors better suited to produce. We can also have investment in human capital. So businesses and increasingly individuals, in order to earn more money in labor markets, we have incentives to invest in human capital. What are some ways that we can invest in human capital? Well, we can spend money on training and education. We can spend money on skill development. We can invest money to improve the health of people. All of these decisions, all of these allocations, all of these investments in human capital have the end goal of enhancing people, of increasing our levels of skills, our ingenuity and creativity, our health, all of our abilities as human beings. And this in turn allows us as humans who serve as the labor component to increase our productivity. Okay, this is going to be really important for your futures, because as we're going to learn in future videos, ultimately worker productivity is the key component to worker wage. If you want to enter the workforce one day and make a healthy salary and keep growing that salary, it is imperative that you are a productive worker, and that either your company, or more likely you yourself, take the time and the money to invest in yourself, to always keep learning, okay? And we'll learn about that. The other broad context of resource markets is that we have to make decisions. We have to make allocation decisions. We have to make investment decisions. But you already have the toolkit to do this, because at its core, these economic investment decisions or these allocation decisions in resource markets are still grounded in the analysis that we've learned, the analysis of marginal cost and marginal benefit. And as we learned a while ago when we were doing product markets, that big rule that we learned, the MR equals MC rule, we're going to also return to that rule to help optimize some of our decisions, okay? So that, my friends, is an overview of resource markets. I want to jump now into a brief discussion of resource market demand. And I want to outline for you a couple of important things that firms look for as they demand resources. Okay, because remember, we're talking about resource markets, right? Input markets, factor markets. So it's businesses that are demanding resources. And one of the critical components that you need to understand about resource demand is that resource demand is classified or considered to be in economic theory what we're going to call derived demand. And what this means is that the demand for any resource doesn't exist in a vacuum, okay? Instead, the demand for any resource stems directly for the demand for the final product that the resource helps produce. Okay, let's say that again. Derived demand implies that the demand for a resource stems from the demand for the final product, for the final good or service that the resource helps to produce. So, for example, the demand for construction workers who build houses is going to stem directly from the demand for new houses. If the demand for new houses goes up, the demand for the resource, in this case, construction workers, will go up. If we have a recession in our country, one of the first things that's always hit is the demand for housing. Okay, whenever there's a recession, the demand for new housing tanks out and it falls drastically. And predictably, construction workers often lose their jobs in recessions, because if the demand for new houses falls, then the demand for the resource that creates it, in this case, construction workers, also falls. Okay, the same thing can be said about people like me. The demand for economics professors is going to stem directly for the overall society demand for thrilling lectures on economic theory. If, for example, society demands more economics lectures, who knows why, but if they did, the demand for the professors that can give those lectures goes up. Let's say that something happened. We don't know what it is, but let's say that something happened and all of a sudden the number of economics and business majors fell. Okay, something happens and the number across the country of econ majors and business majors falls. Well, that would imply there's going to be a drop in the demand for economics classes. And that would then trickle down to me, because as a laborer, my demand is derived. And if there's a drop in the demand for econ classes, there's going to be a drop in the demand for econ professors, because our labor, like all labor, is derived demand. Okay, so that's derived demand. This has a couple of implications. Okay, one implication is tied to the idea of substitutability. Okay, what we believe in economics is that firms will combine resources in a way to minimize cost. This should not be a surprise to you, because we've learned before that profit is equal to total revenue minus total cost. So obviously, businesses have an incentive to minimize those total costs. The way that they minimize those total costs, however, really stems directly from the way that the firms demand and combine resources. And one thing that firms do is they substitute resources. So we believe, for example, that if the price of one resource, for example, goes up, okay, if the price of one resource rises, firms will switch to other lower cost substitute resources. Just as you can substitute products to get utility, firms can substitute resources. This can lead to a lot of very interesting and oftentimes unintended consequences. Let's take, for example, an increase in the minimum wage. Okay, let's say that the state of California really hikes up the minimum wage, which is primarily going to affect unskilled workers. Well, you can bet that if the price of one resource, in this case, unskilled workers, rises because of the minimum wage, firms are going to look around and seek to substitute. There has been evidence, for example, that oftentimes increases in minimum wage lead restaurants to lay off a lot of their dishwashers and invest in more industrial dishwashing machinery. Okay, people get mad about that because then people are out of work, but it makes a lot of sense from this lens. Just as you and I substitute products to get utility, firms substitute resources to minimize cost. And again, we believe that if the price of any one resource goes up, the firms will switch away from the expensive resource and look for lower cost substitutes. And this can have some impact on people, okay? We believe that, other things constant, the demand for a resource is going to be more elastic the more and better subs are available for it. Okay, we're not going to really deal with labor elasticity in these lectures, but I wanted to point out that there is resource elasticity, and that same idea of the number of substitutes will help dictate it. Another takeaway that we have from this discussion of derived demand is that there's these weird chains of events and these weird causations that can occur. We believe in economics that if the price of any resource goes up, it will lead in turn to higher costs of production for the firm. And that in turn will lead to higher prices for the products that are being created. Okay, so let's take this as a chain of events. Let's say that the price of a resource goes up, the price of a labor resource goes up. This in turn will lead to higher costs of production for that item being made. This in turn, based on supply demand analysis, will lead to higher prices for those products. Now up here, we pointed out that firms will substitute resources to minimize cost. Here, we're taking it back to the consumers, because if the price of a resource goes up, which leads to the price of the product going up, we can predict very, very easily that consumers in turn will move away from the higher priced products and turn to lower price substitute products. But this is then going to have even more chains of reaction. Okay, so we started off with the idea up here that a resource price goes up. This causes the price of the item to go up. This causes us as consumers to say no more of those expensive products, and we're going to switch to lower price substitutes. That's all predictable. But now look at the cause and effect and the chain reactions. This in turn will circle back and change the demand for resources. As we demand less of the higher priced item, the demand for the resources to make that product will fall. And as we demand more of the lower price substitute, the demand for the resources to make that substitute will rise. So there's always this dynamic interaction between product markets and factor markets, and a lot of really important, I'll call it cause and effect reactions. A big part of your success in understanding this is to be able to move back and forth between the product market analysis and the factor market analysis, and to really make creative connections between how one change in one thing can ripple through an economy and affect the different markets. Okay. Again, tied to elasticity, other things constant, we believe that the more elastic a product is, the more elastic the resources used to make it will be. Again, we're not going to cover elasticity, but I wanted to kind of lay out for you in case you were concerned about it or wanted to know about it. The final thing to point out in this little video, to wrap up this idea of the context of input, aka resource markets, and how firms demand resources, is this. Just like the demand curve for a product, the demand curve for a resource can also shift. Okay, we said earlier that ultimately resource markets are markets, and they're bound by the rules of supply and demand. And just as in product markets, over here in resource markets, demand curves can shift. And you know that that shift is going to affect equilibrium, which in turn will affect the price of the resource. So we know that resource demand curves can shift. The question you should be asking is, why? And we believe in economics that, broadly speaking, there's 3 general reasons why a resource demand curve can shift. Number 1, a change in the demand for a product. This should make sense because of derived demand. So the first reason, a change in the demand for a product will cause a similar change in the demand for the resources that make the product. Number 2, a big one, changes in the productivity of a resource. You as a worker, for example, the more productive you get, or as technology gives us better and better machinery, more efficient computer algorithms, anything that changes productivity of the resource will alter the demand for that resource. And we typically believe that the higher the productivity, the greater the demand. This should be a lesson that you take out of this class as you move out of college and into your career. Do you want to make a lot of salary? Well, then you need to be in demand in a labor market. Greater demand for a resource if the resource is more productive. So you should always be thinking as you map out your career pathway, how can you, through your education, through investing in yourself, through lifelong learning, how can you continue to increase your efficiency, your productivity? And finally, number 3, going back to the idea of substitutes, a change in the price of a related resource will affect the demand for the original resource. And again, this goes back to the substitutability of resources. Okay, so that wraps up this video, my friends. To give a quick recap, we opened up by giving just a general context of what a resource market is. It's the complement. It's the other half of the circular flow to the product market. We know that in resource markets, households are the suppliers, firms are the demanders. And then we covered a little bit about firm demand. We understand now derived demand and that connection between product markets and factor markets. We also understand ideas of substitutability and those chain reactions. And finally, we know that there is a demand curve for resources. And we've laid out 3 things broadly. We'll go into them in more detail later, but 3 things broadly that can shift that demand curve. And of course, because a resource market is still a market with supply and demand, any shift in that demand curve is going to alter the equilibrium price in the market. Thanks for tuning in. I'll see you next time.